You are looking at a bank advertisement, trying to figure out what your money is doing. You are presented with two three-letter acronyms that both describe interest, but they operate by entirely different mathematical rules. Banks have always prominently advertised massive interest rates to attract consumers. Decades ago, plastering a double-digit yield on a window was the primary way to bring in deposits. Savings accounts boast high returns, like a 5.00% APY. On the same page, loans advertise lower costs, like a 4.90% APR. Banks display the highest number to attract deposits and the lowest to sell debt. This marketing strategy relies purely on the specific acronym attached. Misunderstanding these terms won't bankrupt you overnight, but over a 30-year mortgage or a lifetime of saving, looking at the wrong metric will cost you tens of thousands in unoptimized capital. Here is the golden rule you must memorize. APY is the mathematical reality of what you earn, and APR is the baseline cost of what you owe. APY stands for annual percentage yield. This is the ultimate metric for savers. It specifically factors in the wealth-building power of compound interest, showing you the true growth of your money over 12 months. APR stands for annual percentage rate. This is the metric for borrowers. It calculates the base interest rate you are being charged and adds in the upfront fees required by the lender. There is a mathematical disconnect. APY includes compounding but ignores fees. APR includes fees but ignores compounding. Banks heavily exploit this asymmetric information landscape. To evaluate a financial product accurately, you must learn how to manually translate the numbers to compare apples to apples. To understand the mechanics of APY, look at compound interest. Compound interest means you earn interest on your original money, and then you earn interest on your accumulated interest, creating a final yield that is mathematically higher than the advertised base rate. This chart tracks a concrete mathematical example. We are depositing $10,000 into a savings account with a 10% base interest rate that compounds monthly. Notice the snowball effect. In month 1, you earn $83, but in month 2, you earn interest on your new total of $10,083. Your next interest edition steps up to $84.03, and then $84.73. At the end of the year, your total is $11,047. Your actual yield, the APY, is 10.47%, which is significantly better than that 10% base rate. This introduces compounding frequency. Compounding frequency dictates how often your interest is calculated and added to your balance. If a bank compounds your interest daily instead of monthly, that APY pushes even higher. For wealth building, the base interest rate is largely irrelevant. APY is the only number that tells you the actual cash that will hit your account at the end of the year. Shift to the borrower's perspective. Here, APR is the dominant legally required metric used for mortgages and auto loans. The Truth in Lending Act forces lenders to display the APR up front. The Truth in Lending Act is a federal law that protects consumers against unfair credit practices by requiring clear disclosure of borrowing costs. This prevents lenders from hiding the true cost of borrowing behind a low baseline interest rate. APR bundles multiple costs together. It takes the base interest rate and adds origination fees, broker fees, and points into one single yearly percentage. Look at a practical example of simple interest on a small loan. You borrow $2,000 for a motorcycle, and over the course of the loan, you pay $240 in interest based on the principal. But APR has a critical flaw. While it is great at exposing hidden fees, it often ignores the mathematical penalty of compounding if you pay off the debt over multiple periods throughout the year. APR provides a truer total cost comparison between two competing loans. However, you may actually pay slightly more out-of-pocket cash than the APR percentage suggests. This brings us to the most dangerous intersection of APR and APY, the modern credit card. Credit cards legally advertise an APR. But if you carry a revolving balance past the grace period, that interest actually compounds daily. This chart visualizes how daily compounding on a revolving balance accelerates debt growth far beyond what the advertised APR implies. The flat dashed line is the stated APR, but the steep red curve reveals the aggressive reality of your debt. There is no such thing as a credit card APY in bank marketing. Showing the true compounded cost of that debt would terrify consumers. If you carry a credit card balance, the quoted APR is a mathematical illusion, masking a much higher, highly aggressive debt yield. This chart plots a decision matrix so you know exactly which metric to use in real-world scenarios. Scenario 1 is for the debt-conscious borrower. When shopping for mortgages or auto loans, use APR to compare lenders because it forces them to reveal hidden fees. Compare mortgage APRs with care. For an adjustable rate mortgage, where the interest rate can fluctuate over the life of the loan, the APR represents the cost today, but it does not reflect the maximum interest rate you might eventually pay. Scenario 2 is for the wealth-building saver. When parking emergency funds or cash, exclusively use APY to measure your actual return. For serious optimizers, checking the fine print for daily compounding over monthly compounding is the secret to maximizing that APY. Scenario 3 is for the credit card user. Neither metric helps you if you pay your balance in full, but if you don't, the APR is working actively against you. Do not get distracted by the marketing. Define your role in the transaction. Are you the lender or the borrower? And evaluate the numbers strictly through that lens. Changing interest rates have massive real-world impacts on the cost of living. Historically, borrowing costs and saving rewards drive public sentiment and political pressure. We see street-level frustration, but there is also institutional control. The baseline interest rates are set by central authorities far above the consumer level. You cannot control the federal rate, but you can control how you read a bank's fine print. Look past the marketing illusion, choose the right acronym for your scenario, and optimize your capital.